Go ahead.
Okay, hello, good morning, everyone. Hi, I am so excited to be here. Thanks, Nadine. I don't want to take too much of Bedr's time, but this is the opportunity when you're all together. So it was the time for me to just jump in to say hello. I am now back after, I don't know, 4 months of being away. I had a baby and who is now at daycare, thankfully. And so I can actually be a part of this call. So I'm really looking forward to getting to know you, getting to know what you do as well. Nadine has already told me about a little bit about each of you and the wonderful cohort that you are. So I'm very excited to get to know you. Thank you, Hossam. Thank you, Osasu. And yeah, hope to see you at the Just Look call, but also in the future calls. And I hope that we have more and more interactions and get to know each other a little bit. Please do feel free to reach out to me. Of course, Nadine has already held the fort very strongly, but I'm also here. Thanks so much. And thank you to Chris as well. And enjoy the session.
Thanks, Iran. And Bedr, the floor is yours.
Welcome back. Okay, thank you, Nadine. Welcome back, Iran, among us. Hello, everybody. Last session, we've examined the fundamentals of financial modeling, like forecasting and the assumption, like the result and the main input. I know it was a little bit heavy and theoretical. For this session, we'll try to complete the theoretical part and to see how, to examine the tool that we will work on, and maybe we'll materialize a little bit all these theoretical notions. So as usual, please don't hesitate to interrupt me if you think that it's urgent or essential for you to understand. And of course, I will try to ask you moving forward between each session. Okay, so I will start sharing the screen with you. Okay, so as I mentioned last time, we've seen in part one the importance of financial modeling for startups. And we went through forecasting and assumption, and part three, financial modeling results, and then the input. In this part, we try to examine other supporting elements, which is essentially the working capital, the depreciation, amortization, taxes, and then valuation. We'll see what does it mean, what's the importance of that, especially that this part will be treated separately in the third session. Then we'll see the importance of sensitivity analysis and having different scenarios for our model, and the different checks and controls that we may do to ensure that our projections are foundable. At the end, we try to see rapidly what kind of how to finance this need. Of course, this element is very important, and we'll talk about it in the next session. And at the end, we try to play a little bit with the tool of financial modeling, and we'll take the example of software as a service, as a typical, startup, but we'll see that we can modify it or customize it for any kind of business. So here, I mean, 4 elements that support the startup financial model. Okay, some of the elements mentioned and we talked about in the previous sections include, I would say, some tweaking of the numbers before you get the right information that is presented in the financial statement. So supporting schemes like working capital, depreciation, tax, and maybe needed. Okay. Also, when building a financial model, you automatically structure a lot of data which you can also use for other purposes like company evaluation. We'll see why it's important, company evaluation, and how we can use the outputs of the financial modeling to build a company valuation model. For that reason, those 4 elements are considered supporting and enriching the financial model. So the first one is the working capital. You remember we talked about it in the previous section. We mentioned that we take the account receivable and the inventory and the account, I mean, all the majority of the current assets, and we remove the current liabilities, like especially the account payable, and then we can have the working capital, and then it's a measure that change among years. So what is important for us is the change of the working capital. So here, the working capital, as you may recall, it's the capital that you need in order to sustain your daily operations. So technically speaking, working capital is a comparison of the value of your current assets compared to your current liabilities. In other words, the value is the value of the things your company owns and that can be converted to cash on the short term. Remember that when we say short term, it means in less than 1 year, okay? Compared to the value of the things your company owes to others that are due also on the short term, I mean, in less than 1 year as well. So current assets include cash, account receivable, and inventory. Current liabilities, for instance, include accounts payable. So current working capital is extremely important for startup because it's a measure of both companies' efficiency and its short-term financial health. So working capital can significantly affect cash flow. So if a company's current assets do not exceed its current liability, then it may run into trouble paying back creditors in the short term. So, that could lead, in the worst case scenario, to bankruptcy. How to calculate the working capital, or what we call the working capital schedule example? I mean, we take the projection of the account receivables, whether on a monthly basis or an annual basis. But for annual basis, we need to build the monthly basis as well. And then we add inventory, we add the account payable. Sorry, we remove the account payable and any other short-term payables, for example, for taxes, tax administration, also we owe the tax administration payments in 3, 4, or 5 months. We remove it from our short-term assets, and we get the net working capital. And you see here each time that sorry, here we see clearly that what's important for us is the change in the net working capital. So each time we take, for example, for the first month, we have the ending net working capital is 9,000. So we take the change as it is, and then in the next year, we calculate the difference between n plus 1 minus n. So 10,705 minus 9,003, and we find the change, which is 1,702, which is the change in new working capital. So here, if it's like a positive, so it's a good thing, and better when it's conversion towards zero, okay? Because I mean, the ideal thing is to, at the end of the day, a treasury which is not far from different from zero. But if we have a negative funding, we need to bridge that gap, and generally by looking for short-term loans from the bank. So the second important element is the depreciation. You remember when we talked about it last time. So depreciation and amortization indicates the value reduction of assets the company owns based on the value of an asset at its useful lifetime. Depreciation is calculated. So depreciation is part of the profit and loss statement and impacts the value of assets in your balance sheet. As an example, let's say that you want to buy some computers for your company, and they cost you like 20,000 euro, and you can use them for 4 years. Okay, so this means you will write off the total investment of 20,000 for a period of 4 years, which means you would depreciate their value with or by 5,000 euro every year for the upcoming 4 years. So the financial model needs here to needs a separate scheme that calculates depreciation based on the investment and their related useful lifetime. And here, for example, you can find an example of the calculation of a depreciation. Okay, so we have in the third line the capital expenditures. We've bought in year 1 computers and software and office equipment of the value of 20,000. Okay, and then you see that we have like the depreciation amortization table. We can take an assumption of the depreciation rate. Here it's regulated for each kind of equipment. Generally, we have a rate, and there is different methods of depreciation. No need to go on that detail. So, but keep in mind, the most common method is linear depreciation. I mean, which is, for example, if we depreciate these computers on 4 years, we take like 25% rate. Okay, so 25 minus 4, it gives the total value of the assets that you are depreciation. And the economic rationale behind that is to smooth the cost of this equipment to correspond to its economic lifetime. Okay, so generally we use computer for 3-4 years and then we replace them. Okay, so economically speaking, we should consider their cost over the 4 years. Okay, of course, as we mentioned last time, there is other logics and rationales, tax logic or accounting logic, etc. But let's keep in mind this approach. So here for year 1 and year 2, year 3, year 4, we smooth the value, or we split it up on this 4 year, 5,000 each year. Then in year 2, we bought another set of computers with amount of 3,000, and we take the same assumptions. So we depreciate over 4 years, 7,500 euro till year 5, and then we have the total depreciation for year 1 it's 5,000, then 12,500 till year 4, and then we go back to 7,500 as our first investment has been totally amortized or depreciated. So this total depreciation, it will feed the P&L statement as in the depreciation case, and then we use it back. We add it back when we will calculate the cash flow statement, as we mentioned that if we record that it's a fictional or not realistic expense that we use only for tax purpose. Okay. So taxes, as we mentioned just now, the tax purpose. So every company that is incorporated and registered at the Chamber of Commerce or any authority, registered authority or habilitated authority in the country has to pay yearly taxes over its financial results. It's what we call the CIT or the corporate income tax. So they are deduced from your results before tax, and it's the before the last case in the P&L or the income statement. So if you want to include tax carry forwards in your financial model, you likely need a separate tax scheme as part of your model. So a tax carry forward works as follows. So as an entrepreneur, it's likely that you have negative results in the first couple of years, or maybe the 3 first years of operation. So if you have negative results, this basically means that you have expenses that exceed revenues. You have more than income, so which leads to an operating loss. If you have a loss, there is obviously no income to be taxed by the tax authorities. So this loss can be leveraged in the future tax reporting periods to offset taxable income. So it's an advantage, a tax advantage that the authorities give to new business, new entrepreneurs, or any other entrepreneurs to leverage any kind of loss in the future tax reporting period to offset the future taxable income. So it's literally you carry it forward. Of course, this will reduce the amount of tax you will pay in this specific tax reporting period. So here, I mean, an example of how we calculate or how it is present. Generally, we take an assumption about the tax rate for the period, and we take the earning before tax, and we apply. If we have a loss, so we don't pay taxes. For example, the first year we have 50,000 of negative income of a loss, so there is no tax applied. In some countries, they have like a minimum of tax paid. So with whatever you have a benefit or loss, you have to pay a minimum amount of taxes. So we just put it as a forfeit. Okay. In other countries, also, as a new startupper, you have advantages. You don't pay taxes, maybe, or any social contribution for the first 3 to 5 years. So here, you just whether you pay the minimum tax rate or the minimum tax required, or you left it empty. Here, for the year 2, for example, we've made like an earning before tax at 230,000. So now we reduce the amount of loss accumulated in the previous years. Here we have only 1 year of activity, which we registered 50,000 euro of loss. So our earning before profit is no more 230,000. It's becoming 180,000 since we offset the loss we've realized in the previous year, and then we simply apply the 23% of tax rate. For the next years, we have already, absorbed our previous loss, so no need to consider again the loss, and we just apply the tax rate on the EBT, and that will allow us to calculate the net income next. Of course, if we have a tremendous loss that could not be absorbed by the benefit realized in the next year, we offset it, or we invest it in as much period as necessary, or as much years as required to absorb all the loss. And we start paying a full tax rate on a full tax basis once we have resorbed or amortized all the loss registered for the years before. Okay. So we've seen the main, elements that or tricky elements that contribute in the construction, essentially, of the P&L statement. You see that we need revenue, we need the direct and indirect costs. We need to calculate the EBIT, the EBITDA, the depreciation, and the tax, and also the interest by having the loan amortization table. Today we've made a little focus on working capital, which is very important notions, and about depreciation and tax. And now just a mention about the importance of valuation, since we'll maybe make a deep dive for the next session. Just will talk about rapidly. So here, as mentioned, so many startups build a financial model for the purpose of raising funding. Part of the fundraising process are negotiations with an investor about the valuation of the company to be invested in. So the good news is that when you have built a financial model for your company, all the ingredients are there to perform evaluation by means of the DCF method, discounted cash flow methods. Of course, it's not the only method, but it may be one of the more common ones. In the next session, maybe we'll take a look about the main known ones. Some ones are really straightforward, others are more sophisticated and require a professional touch and someone who's really in to help you drafting the valuation and preparing the valuation of your startup. So here the main advantage of the discounted cash flow method is that it values a firm on the basis of its future performance. This is perfect for a startup that might not have realized any historical performance yet, but the startup may not have realized any historical performance, but it expects a large future earning. So during this stage, it's common really for startups to not generate any revenues at all yet. While discussion with investor regarding its ownership percentage and the accompanying valuation already takes place. So the DCF method is suitable in that case. because we have no history, no track record, and we have a tremendous potential, or at least we hope for that in the future. So this method, in opposition of a lot of other methods, it weighs future performance more than current one. Okay, so the main downside here of the DCF method is the quality of the valuation is extremely sensitive to the input variables of the formula. I explain myself here. Let's take the example of a startup that we expect that it generates $100 of cash flow each year during the 5 upcoming years. Okay, so here you see in the first line that the cash flow 100 and 100 and 100 and 100 and 100. Okay, and we put the assumption that at the end of the day, at the end of year 5, we will sell our startup and it would value like $300. Okay, we call that the terminal value. Okay, so how to calculate the discount cash flow method is just we take all the expected cash flow, for sure they are projections and expectations of our performance in the next 5 upcoming years, and then we all agree that $1 today does not equal exactly like $100 in 1 year or in 2 years, on 4 and 5 years. Okay, because of different elements or different reasons. The most known reason is inflation. Okay, because by time, generally money loses its value. Okay, so with $100,000 or $100,000 today, I can buy things that I cannot afford in 1 year or 2 years or 4 years, because things or goods and services are becoming more and more expensive. People take into consideration the opportunity cost or the cost of the money. They make a trade-off between putting money in a saving account or investing in a project, etc., etc. Okay, so and also, as I mentioned, that investors, each time when they decide to put a penny or a dollar or an euro in a business, they try to make a trade-off or an arbitrage between putting the $100 in your startup or putting in the financial markets or any other startup or any other business. So he will require a certain rate of return, okay, for this business. Okay, so he say, okay, I won't put any euro in this in your business unless I am sure that it will report to me 20% like in 5 years or 10% in 2 years, whatever. Okay, so because he's comparing between putting his money in your business or put it in any other investment. Okay, and for sure he will make also a trade-off between the perspective or the potential of development, of profitability, and the risk. Okay, so for a startup, it's very risky because the statistic says maybe like 2 among 10 could cross successfully the death valley in the 2 first years of existence. Okay, many will suffer, but few of them will brilliantly survive among this period. So it's investing in a startup is very risky, at least from an investor point of view. So it requires a return that is equally or proportional to the risk. So here the couple potential return versus risk is very important. Okay, so when the investor will put his money in a bank account, okay, or buy like bonds or maybe treasury notes, etc., it's not a very risky investment because he will be quasi sure that he'll get his money back at least, or if he will lose some money, he won't lose all his money. So he will require like a return of maybe 2, 3, or sometimes 5%. But if he will put his money in a startup, he will require much bigger rate of return, like maybe 12, 15, or sometimes 20 or maybe percent, because you know that this amount or this required rate of return will shift or will compensate the potential loss of the business. So in mathematics, to take account into this the time factor and also requirements of investor, we use what we say the discounting factor. Okay, so no need to go into details, but generally it's something that we buy this information from, Bloomberg, from Thomson, from specific data providers, or maybe the consultant who is in charge, or to provide or to make evaluation will make his own job to determine which is the discounting factor. Let's take here the example of 10% discounting factor. What could be, analyzed as probably to take into account inflation up to 2%, and then maybe risk of or required return of 8%. So let's assume that here for our case, we have like a 10% required return, or 8% required return and 2% inflation, which make like a 10% discount rate. So we divide the amount of this cash flow on the discount rate, and taken into account of as an exponent of the number of years. Okay, so here we see each time is we multiply 100 by 1 and we divide 1 plus the discount factor, and we here the n is to take into consideration the time running. So here we divide by 1.10, we find 91. Here we multiply by this discount factor, etc., etc. Okay, and here, as I mentioned, we suppose that at the end of year 5, we will sell our startup at the amount of 300. So 300 today, in 4 years, okay, in 5 years, we consider it as like is equal to $156 today, okay, because we have to use to remove or to convert all this money as as per today, okay. So we use the discount factor, and then we make the summation of all these amounts, and then we have the discount cash flow value of our business is 565 million if we consider here, it's in millions, okay. So it's the more common and the more easy way. You see that the drawback of this method is it's very sensitive to the assumption of the discount factor, because if the discount factor is high, then the discounted amount is less, and the value of the business is reduces, okay, is minored. And so generally the investors will use a very orthodox or very pessimist or very cautious discount rate. And generally, the startuppers or the owners try to negotiate and try to justify a lower discount amount and a higher cash flow expectation. Okay, so here we have like two variables, which is here the projections of the cash flow projection, with it should be as bigger as possible, as important as possible, and in the other hand, we have the discount rate, which should be as low as possible because we take it in as a denominator of the calculation. Okay, so I don't know if at that level you have any questions or comments. Before moving to the next session. Okay, thank you, Hassan. Move forward. Okay. Once we've done with our calculation and our modeling, we have like raw version or a standard version. Okay, so we need to reach the final version. We need to make two things. I mean, the first of all is creating variation of the model, okay, and to expect what if we change some assumptions or some figures, and also we perform some checks that it's very important to have like a coherent and soundable output. Okay, so what we mean by creating variation is to perform what we call scenario analysis and sensitivity analysis. Okay, what we mean by scenario analysis. So here, I mean, entrepreneurs tend to be sometimes too optimistic. If we say what we can say the pet project, because it's our startup, it's our project. We are like, we can't be nothing but optimistic. Otherwise, we don't have to start our adventure. Okay, but sometimes this optimism could be impacted on figures and could drive to error. So we need to establish variations of the initial model to take into consideration uncertainties and surprises that could impact the business. So this is possible by using at least three methods: the scenario analysis, the sensitivity analysis, and the stress test. So the difference between the two first methods is that sensitivity analysis examines the effect of changing just one variable at a time, while scenario analysis assesses the effect of changing all the input variables at the same time. Okay. Let's take an example. For example, for a P&L statement, a sensitivity analysis is to each time we change only one factor, whether the rate of the development of sales or the percentage of the costs or the costs as a percentage of sales. For example, we change only the tax rate to see what would be the impact of the change of regulation on our business, and to change, for example, the depreciation rate, because sometimes we have a room, we have a window to choose our depreciation rate. In some tax regimes or some accounting regimes, the entrepreneurs in some sectors or for some material or some investments, you have the right to accelerate or to put like a high rate of depreciation to have more charges in the first year, okay, and less in the upcoming years. Okay, some others want to smooth or maybe to have more charges in the third and fourth and 5 years, since he's expecting not paying tax in the first years. So to optimize tax and reduce the tax payment, you have interest in having a depreciation rate which is small in the first years and then moving more and more bigger in the last years to inflate costs and expenses and then reduce earning before tax and thus reduce taxes and improve or maximize net income. Wherever in the scenario analysis, we can move or we can change or play on different rates or different assumptions. For example, we can say that let's assume in this case that the rate of sales will move from 5% to 10%, okay? Or let's take into consideration the seasonal fact in our business, or let's assume that a higher rate of inflation, so the salaries and the personal cost and then every other inputs like direct cost will be rising consequently, okay, etc., etc. Okay. Here, generally, the scenario analysis lead to creating like 3 cases. Okay, generally the base case scenario, which is refers to the ordinary scenario, the more expected under the current conditions. Then the worst case scenario, I mean the most extreme situation that can happen, of course, under a normal condition. For example, low raise of sales, or maybe the costs are more important than we have expected, etc., etc. So here it's worst case scenario because the revenue they are at their lower level compared to other scenarios, and the costs in their most important level compared to the other scenarios. And we have the best case scenarios. It reverses to the most favorable projected outcome. Okay. Here, for example, the case of the scenario dashboard. Okay. For example, we talked about 3 cases: the base case, the worst case, and the best case. Sometimes we can even choose other scenarios. Okay, so here, for example, you see in the left, we have 5 scenarios. Okay, the base one in blue, the conservative, which is orthodox or not worst case, but it's more like more humble scenario, let's say. Then the high case, which is the best important scenario, and then the lower case, and the target, which is the more realistic. Okay. Here we see that the best scenario is the best one. Okay, but it's a choice of the entrepreneurs, which is important is to justify and to back all these assumptions, because investors will dig into these details, and it will challenge you on the different hypotheses and assumptions you've taken. Okay, so then we can make a zoom on each scenario here. For example, the target one, we have the volume. This is in volume, which mean the orders, and then the cash flow. We see here the operation cash flow and financing cash flow, and in yellow the evolution of the net cash flow, or the changing of the cash flow. Okay, we see the order, and normally the revenues are in the same level or the same rhythm, since they are correlated. And then at the end, we see that the different indicator of earnings, whether the total revenue, or the EBITDA, or the net profit after tax. Here, for example, is a sensitivity analysis. Okay, we're here each time we change only one factor. Okay, so here, for example, if we take the case when you change revenue growth, whether plus 5% or plus 10% or plus 15 or plus 20. So each time we change only one factor. Okay, and we see, for example, here the exit the value of the business using different assumptions of exit multiples. Okay, and we can each time change only one variable and see which is the impact. For example, here in the next line, or the next set of lines about the assumptions, we can take the hypothesis of a change of the revenue growth, whether minus or plus 5%. Then we change the COGS while keeping everything equal. We can also play around on the discount rate, or even in some ratios like the enterprise value on EBITDA, exit, etc. And then we see how much the input will change. Okay, whether by 4% or 8% and 12%. Okay, and then we will see the degree of vulnerability of the business. I mean, we expect that how much change, how bigger is the change, whether we move one or other variable. Okay, and we can see, for example, here in this case, that the business is more vulnerable or more sensitive to a change in the revenue growth assumptions rather than the discount rate, or at least the COGS in the second place. Okay, so here the investor will really, if he see that in the sensitive analysis that more, erratic or the more sensitive elements in the revenue, he will concentrate, he will maybe put more focus in analyzing the revenue growth rather than the discount rate, because any 1% change in the revenue could impact tremendously the benefit or the earnings at the end of the day. Okay, that's with the importance of the sensitivity analysis. And as a startup, we are lucky if our performance change slowly rather than drastically for each change of the assumptions, especially those of costs and revenues. Okay. So we've seen here the scenario analysis, the sensitivity analysis, and now we see the stress test. Here, I mean, honestly, as as an investor or part of investors, I really rarely see startups that make a stress test. Okay, but even major businesses or others don't have the resources or the ability, or maybe let's say the technique, or even the tools, the box tools to perform the stress test. Okay, and generally it's not required, it's not mandatory. It's nice to have for you. So, and better we know what does it mean rather than not. So, what's the difference between the stress test and what we call it the worst case scenario examined earlier? The difference is for the worst case scenario, it refers to the most extreme situation that can happen under common and normal activity conditions. Whether a stress test aims to simulate the sustainability of the business under abnormal market conditions and extreme internal or external events like health crisis, the famous COVID-19, for example, and border closures, abrupt regulatory changes, economic crisis outside the economic cycle. Economists among you know what I'm talking about. Prolonged strike of the trade union, of the workers' union, abrupt change in consumers or suppliers' conditions. So the stress test could also concern the solidity of the model itself by checking the formula, etc., etc. Okay. Here, for example, a case of stress test. What if one of our investors decides to drop his money out and to leave the company? What does it mean if, for example, one of the key persons, our key developers in the business, left the business? Okay, so here, I mean, that's under abnormal activity conditions, and to see whether the business could survive. We are here not talking about benefits or loss, etc., etc. Here we are discussing the sustainability of the business itself and its resilience. Okay, here to stress that will give us an idea what are the most important external or internal variables that harms our existence. Okay, so I suggest to take like a 5-minute break, and before that, you feel free if you have any comments, questions, or suggestions regarding the elements that we have seen in the previous hour.
I can play some music for 5 minutes while people grab a cup of coffee or put their questions down in a chat. For that, maybe Badr, could you stop sharing your screen and then we can reshare when the break is over? Thank you.
Done?
Yes, thanks.
And the track is over. It was exactly 4 minutes, 55 seconds. So I guess the break should also be over. That's what you say?
All right, let's resume. Start by sharing the screen. So after making our financial model, I mean by creating especially the balance sheet, but for sure the P&L statement and the cash flow statement, because here I forget to say that generally we expect from the startuppers to provide the P&L statement and the cash flow statement rather than the balance sheet, because it's not very important, but not very important at this level, at least. And as we mentioned, that it gives only a snapshot of one period. But what is more important for the investors and for ourselves is to see what is the stream for the next year, which is better reflected by the P&L and the cash flow statement. But we can use, I mean, the input of the balance sheet to build what we call the investment schedule, okay, or the investment financing table, which is just a table where we detail the different type of investments needed for the covered period. And in the other hand, how we will finance them. Okay, so it's like we use maybe the same format of the balance sheet. It means the active or assets in the left, and maybe the liabilities or the financing in the right. And then we just detail the different of investments, whether as non-current or lifelong assets or current assets, etc., and then how should I finance them by equity up to certain level and by debt up to certain level, and then we detail what is in the equity, whether it's like internal reserves, I mean personal funding, love money, donations and grants, honorary loans, participative credit, or a participation from a VC or a seed capital, etc., and of course the co-founder, etc. And then in the debt part, we can put the leasing, financing, the long-term debt, and any other potential short-term financing, even if it's a facility of payment from our suppliers. So once we gathered the different inputs for this financial model and challenged it and backed our assumptions, we moved to build these different outputs, the different financial statements, and then we perform the variations, whether the scenario analysis or the sensitivity analysis, and as a nice to have, we stress that. After all this, we perform an internal sanity check, is simply to avoid or take from other lessons learned to avoid some mistakes or some misleading elements that could reduce our credibility or the quality of our output to our different stakeholders and partners. So the first one is a mismatch between the financial model and the business plan. Okay, so here the financial model, it should resonate with the overall business strategy, since the outputs or the main finding of the business model should feed the business plan itself. Okay, and we are when we are, for example, taking an assumption of zero tax rate, that we are expecting maybe in the 3 upcoming years or 2 upcoming years, the advantage of that the government has already given to the startup to encourage the startup ecosystem to flourish will come to an end. So when we are drafting our SWOT analysis in the business plan, we should mention that as a threat, external threat, but it should also figure in our 3rd year of projection in the P&L statement that we will start paying taxes. Okay, and if we see an opportunity in the 3rd year of activity by accessing to new markets or getting maybe a patent or getting the authorization to sell some new products, that should be reflected in our projections. So the idea is here to avoid discrepancies and to avoid divergence between what we suggest and we propose in our business plan and what is reflected in the financial model. Okay, because globally the financial model gives the financial or the figures or gives a voice to your business plan. Okay, it's not 2 separate drafts that have separate lives, but there's something complementary and should be drafted with close attention made to them. The second sanity check or error not to commit, we have already mentioned that, is being over optimistic or having even a very pessimistic revenue projection. So don't don't be unnecessarily humble by trying to show to your investors or partners that we are not exaggerating, but maybe you risk to that all this plays against you, because you need to show your enthusiasm and your beliefs on the future on your business in your presentation, and figures should reflect your optimism, but without exaggerating and without putting unrealistic figures or assumptions, because that make your arguments not valuable or not soundable. So we will see. You can go back to our previous session when we talked about revenues and how to forecast sales. Don't hesitate to cross check with the 2 methods, whether the top-down or the bottom-up method, and to look for benchmarks and be sure that your assumptions are of growth corresponds or within the norms of your sector or your industry, or maybe some peers. Okay, so try to have a backup or justification for each set of figures you make for each assumption you're taking. Okay. If avoid to put funding or financing needs which is not explained or not backed. Make sure you include the breakdown of costs everywhere and for every step you put. So the fourth thing which is important is that underlying assumptions that are not clearly defined. So we need, you should be able to provide clarification or proof to the numbers. And it's like a corollary or a consequence of what we mentioned in the sanity check number 2. 5 is to reduce unnecessarily or to underestimate the number and also consequently the cost of employees you need to build a fast-growing company. A startup, by definition, is a business that starts and goes rapidly up. Okay, so you will face, starting the third year, a great or an important period of fast growth and huge growth with a huge need and costs that grow dramatically. So don't put optimistic revenue projections, and you keep prudent or orthodox cost growth rates. So we need to be coherent in wherever any part. If you are conservative in revenues, you can be normally conservative in costs and vice versa. Okay, but if you are optimistic in the revenue growth and conservative regarding the costs, including personal costs, that make it feel for your stakeholders and partners to see, look, these guys are just trying to provide us with what we need to hear, and they are not really realistic in their and maybe serious in their projections, and that affects the perceptions for your next presentation. Is error not to commit is that the revenue projections which are not aligned with the market size. As it's obvious by definition, revenues cannot be larger than the size of the market, and we emphasize on that when we talk about avoid too optimistic projections and take care of your the methods or the approach you're using to calculate revenues and the methods, because if you consider the peers, if you consider the industry and the rate of growth of all those people or all these factors, for sure you will be aware that you shouldn't be, I mean, unless being the future Facebook or Tesla, you couldn't give unrealistic achievements, which not justified or correlated by the market. Also, the operational expenses that are being left out. So make sure expenses are aligned to your strategy. Okay. Operational expenses which are misaligned with the forecast revenue. Okay. Again, we are still talking about costs as personal costs and operational expenses that should be aligned with the forecasted revenue. Okay, so make sure that expenses resonate with revenues. No realistic view of the gross, EBITDA, and net margin. Here, when speaking with investors, always be prepared to answer questions on your current and expected margins. Okay, which is the most important for our investors. They don't speak generally figures, but they speak ratios and margins. Okay, so keep in mind, try to talk about margins because they make them more comfortable, especially if they know the market, they know the industry, and they don't specifically technical, are not well prepared in the technical side. Okay, to challenge you on the growth rates of your different cases of P&L statements. The last error not to make is to regard or to ignore or to underestimate the importance of the working capital. So do not underestimate the effect of payment terms on your funding needs. Most startups take care or are constantly concerned with how to fund their investments, how to fund long-term needs, how to find VCs and long-term and mid-term loans, but they forget to planify or to budget their short-term needs, because if you have any working capital needs, then your bank is essential to provide you this temporary or this revolving loans to avoid supporting unnecessary and costly financial expenses. So talking about financing, here the opportunity to talk about what kind of finance or what kind of financing any startup needs for starting, but also for developing and for its day-to-day activity. So do you have any comments or questions regarding the previous sections before we move forward? Okay. So here is a sample how to raise money for your startup. Okay. Two main ways. Okay. So many startups create a financial model because they are looking to raise external funding generally. Let's be honest on that. Whether you are applying for a loan at the bank, trying to convince an investor of the potential of your firm, or are applying for a subsidy or grant, in most, if not all cases, you will need to provide your counterparty with a financial plan. We are all okay about that. Okay, so there are different ways of raising money for your startup, and this can be categorized into two main categories. Okay, financing is your debt, and financing your equity. Okay. So for debt financing, an example, debt financing is like can be a loan which you receive where you agree on specific terms regarding payback and interest. For startups, it can be difficult to receive a loan from a bank as they often do not meet the minimum criteria in terms of revenue generation and offering and collateral offering. Okay. However, some other debt channels are still affordable for startups, like participatory loans, crowd lending, leasing, etc. Besides investment needs financing, banks are still predominant player for activity financing through working capital loan products like revolving, other short-term loans, confirming, supply chain, international trade financing tools, etc., etc. Okay, payment facilities also from suppliers are also considered as an efficient financing source. So what I want to say that banks maybe is not your first reflex or first door to knock out when you're looking for financing as a startup to finance your acquisitions, your investment, etc., etc. Generally, it's done by equity. Okay, but when you've already started working, started your day-to-day activity, you need to open a bank account. You need to make some activity, some movement in your account, and then after a period of maybe 3 to 6, maybe 1 year, you present your dossier to your banker asking for some list or a package for a short-term loan to finance the acquisition of your inventory, to finance your client facilities, okay, and to finance any potential gap of your treasury needs, and the amount of those loans depends on 2 factors, on your relationship with your bank, but also on your good planning or good budgeting of your working capital needs, okay, because the short-term financing are expensive, are not easily affordable. So if you ask more than you want, for sure you will pay more interest and more, and it will affect or impact your profitability at the end of the day. Okay, so good budgeting of your day-to-day, of your operational needs is important to optimize or to well manage your financing, your operational financing, and your debt financing. Of sure, if you negotiate good terms from your suppliers, pay them in 30 days, 60 days, and sometimes 90 days, and maybe why not more, it's considered as a loan, as a facility, a payment facility that will ease your the due of your payables and reduce the needs, your working capital needs. Example of financing via equity is funding. You would raise from an angel investor or venture capitalist in return of shares of your startup. For startups, financing via equity is more common than debt financing for the reason we mentioned earlier. So, because receiving a loan can be difficult, banks are more risk averse, whether professional investors like angel, VCs, or crowdfunders, etc., or look for maybe more profitability, more return, and accept to take more risk by exposing their investment to startups. Equity investors take more risk by investing money in companies in exchange of shares. So since an equity investor becomes shareholders, when he or she invests in your company, you will partly lose control of your firm. So also you will need to share your profits with your new shareholders, and they might want to be actively involved in the management of the company as well. But you know, it's the price to pay. Other sources of equity could be love money, the famous 3F, family, friends, and fools. Also crowdfunding, and also subsidies or grants from NGOs, from accelerators, incubators, from government entities, prizes, challenges, hackathons, etc., etc. Okay. Convertible loans also could be advantages, as no need to issue shares, and valuation discussion are postponed until the moment the value of the company can be better determined. I mean, for an investor, for example, he will put your money instead of acquiring shares and be part of your core equity. Remember, when you talk in the balance sheet, you talk about capital shareholders and quasi-equity and permanent resources. So convertible loans are permanent resources, but they are considered as quasi-equity. They are not part of the capital. Okay. So here you won't issue shares. So it's less complicated, because for issuing shares, maybe you need to change the legal jurisdictions or the legal structure of your company. You will dilute the control, etc., etc. And maybe also the investors see that, or maybe you see that it's too expensive. The investor is having very tough conditions. So here the convertible loans will postpone this negotiation after 4 or 5 years, when horizons is more clear, when the perspective of developments are set. So here the investors and you also have the right or have the possibility to choose whether to get back his money like you pay an ordinary loan, or to convert these bonds as shares in your startup. Okay, that's grosso modo the convertible loans meaning. Of course, all this, don't worry if you see that some technical words that you're not familiar with, because we'll talk about that for the next session next time. Okay. So before moving forward to the case study, I want to take like 5 minutes, less than or maybe less, to make you absorb all this. And for some of you who have maybe some questions or something to comment about what we have seen in this session, or maybe the session before. So please feel free to intervene before we move to the case study, examining how to deal with a financial model specified for service, a software as a service startup. Okay. So guys, ladies and gentlemen, if you have any comment or question or something, maybe something which was not particularly clear, please don't hesitate. And don't be shy. I will not move until the most courageous of you will try to intervene. Is it all clear?
Yeah, Bedrin. Hi.
Hi.
Yeah, it's all clear. It's I think the reason why most of us are silent is because it's intense. So you have to focus and think about a lot of this.
Thank you, guys.
I have a question, Bedrin.
Thank you, Hassan. Yeah, Chris, please.
if someone at the startup stage is offered the choice of either equity or convertible note, and you said, the convertible note might convert it into equity in the future. So which one should one go for? Is there a way for you to determine, especially when you're at very early stage and you don't know how to clearly determine your valuation? Which one should one go for?
Yeah, very good question, Chris. Me as an investor, as a startupper, I'd like to go to convertible financing, convertible bonds, because that prevent me from because at the beginning, generally startuppers have no bargaining or less or few bargaining power in comparing to the investors. Okay, generally we don't ever negotiate. We don't have windows for negotiation. So the investors come with their ready to install a solution or process. Say, I finance you $1 million and I take 20% of shares. There is no negotiation. Take it or leave it. Okay. Some others, maybe especially angel investors, or more maybe let's say human, would prefer maybe the convertible. So generally, the startuppers have no choice. Okay, but if it's up to a startupper, for sure, convertible bonds will be more suitable because it will postpone the negotiation of shares till the perspective and the potential is really clear and the valuation has been already made. We have enough material and enough inputs to make a realistic and more stick it to reality valuation. Okay, because at the beginning, if you convert or we take a financing as part of equity, we will lose immediately some part of the control. Wherever for the convertible bond, the investors are not part of the decision. So if you could please. Okay. Thank you. Because by convertible bonds, we will avoid diluting the capital, we'll avoid diluting the decision making, okay, and we'll have more space, more time to value properly our business. Okay, so convertible or participatory loans or any other quasi-equity which does not impact directly the capital or the equity is preferable. Okay, especially if, for example, we are a limited company or person company, and we need to change the legal structure, etc., etc. So all this is very time demanding. So generally, any other quasi-equity is preferable to equity, but unfortunately, we don't have enough bargaining power to impose or to negotiate with the potential investor, at least maybe for the first round or the Series A or B, but maybe by time when we take more insurance and more self trust and our startup is starting to make revenues and to acquire clients, then we can renegotiate and the offer of financing will become more abundant, and then we have more choice to negotiate the better terms for us. And in next session, we will see how to negotiate these different term sheets and elements with any potential investors, and how to evaluate our company using the best methods to value or to emphasize our achievement and our potential. Okay. So any other questions before moving forward? Okay, great. Here, the templates that we will send to you which is customized for the SaaS kind of financial model template for SaaS business. But you can customize it for your businesses by changing some elements, because as we see, all the elements are generally the same, especially maybe some specification. Here, the first page is the cover page, ignore it. Okay. Here are the instructions. It will guide you step by step in filling the tables. Okay. So here, the different controls, okay, and the assumptions. So we will move through the document. So here we can start by putting the global assumptions for the model. Okay, so here I simply add that the start date of the model. Okay, and those are different commands that would help you. I'll guide you through your the different steps. Keep in mind that cases in yellow that are cases that you should fill, and cases in gray or other are generated automatically. Okay. So here you enter the company name. Here the weighted average costs of capital. We have not explained that, but you remember when we talked about the DCF method, we just mentioned that we use a kind of discount rate. Okay, there is a lot of kind of discount rates. Okay, and here for specialists of professional of finance, keep in mind that one variation of the discount rate is called WACC, and it's maybe one is the most common one, which is the average of the different costs of the company capital. Okay, for example, you have acquired loans at, let's say, for example, 5%. Okay, let's assume that you have an investment of 100,000 K. Okay, and you took a loan of 50,000, which is represent 50% of the total investment with a cost of 5%. Okay, and then a VC entered in your capital with 50,000. Okay, so you finance all your needs, which are 100,000 by that at the level of 50,000, which represents 50% at the cost of 5%, and then you give a 50% shares to this VC, who is requiring like 8% return. Okay, so in other words, he will require to have a dividend each year, 10% of his initial funding. Okay, weighted average cost of the capital will be, I mean, we have financing 50% with a loan, which costs us 5%, and 50% with equity that costs us 10%. Okay, so here we calculate the work as follows: with a 50%, which means 0.5, minus 5%, which is the cost of the loan, plus 50%, which is the share of the equity in this financing, or 0.5, minus 10%, which is the required rate of return. Okay, so the total will be 7.5%. So the WACC would be 7.5%. Okay, so we can add, complicate the calculation by considering the opportunity cost, by considering the interest, etc. But at the end of the day, let's keep amount, for example, of 7.4%, or in this case, 15%. Don't worry, because next time, in the next session, we will talk in more details about WACC and discount factors. So if it's not really clear for you, keep in mind at this level that use the WACC to discount the amount of money or future income, okay, to have like an actualized amount as per today. Okay, so here the beginning cash balance. Okay, so if we just started the business, obviously it's zero. Okay, otherwise we put any initial cash balance as it is in our accounts. Okay, here percentages of sales spend dedicated to new business sales. If we are a new business, for sure it's 100%. If we are an existing business and we just developed a new activity, that will represent 50% of the total share starting year one. We just mentioned put 50%, otherwise we keep it as 100%. The same for marketing. I mean, here percentage of marketing spend dedicated to new business sales. And here is research and development. So if you are not capitalizing R&D for new products, capitalizing what it means, you remember when you're talking about amortization and depreciation that the authorities gives us sometimes the chance to freeze some huge expenses, not to consider that as an ordinary expenses as a COGS or operational expense, because if that appears in the P&L statement, that will be too big, too huge, and that will not reflect the reality of our activity, because it will create a tremendous loss that will reflect in the attractiveness of our business to other stakeholders, but also in the fundamentals and the structure of and the sustainability of our business itself. So the government gives us the right to capitalize the expenses we've made in research and development. It means to freeze them and to consider them as an investment, and we treat them as we bought an equipment or a land, etc., and we put them as an investment, and then we depreciate them over the period of our activity, generally 5 up to 10 years. It depends on the usage. For example, if we invest in R&D to have a patent or a new product that will continue to sell, or an MVP that will continue to sell during 5 or 10 years, we can depreciate the whole amount of this period. Okay, so if you are not here capitalizing R&D for new products, enter the percentage of spend that is dedicated to bug fixes and maintenance, and this percentage is used in the average cost of service of calculation on the summary tab. Okay, the RCS is an indicator. You remember in the last session we talked about KPIs, and I gave you a link to a website with different KPIs per business. So if you go to a SaaS business, you will find this cost of service of calculation as one of the different KPIs. So here, 0 if you're capitalizing software. I mean, if you're capitalizing all the software are considered as investment, so it will be all capitalized here. Okay. So then we move to the revenue part. Okay. So here you see that we have revenue C, B, A, because the assumption if you have maybe 3 types of product. Okay. But if you have only one type of product, you just fill only one table and remove the others in blank. Okay. So here you enter whether it's MRR or ARR, depending on how you sell. MRR is the monthly recurring revenues, and ARR is annual recurring revenues. As I said, this template is for SaaS business, and business who are selling software or any like kind business use this metrics as a part of the revenue forecast. It means the monthly recurring revenue or the annual recurring revenues. I mean, the revenues that is generated through contracts and or agreements with clients. Okay, so we consider people we have already signed with them agreements, or they have subscribed for a pack or for a subscription, a year or monthly subscription. Okay, we don't consider people who one shot or use the product or the service once without any or using freemiums, etc., etc. We consider people who have subscribed for a package where the minimum package or the premium package, etc., etc. Okay, so here we choose whether we want to calculate on a monthly basis or an annual basis. Okay, if we put it annual basis, it will consider it, I mean, divided in 12. Okay, and or it's annual. If it's monthly, it will consider it as a monthly basis. Okay, so here it's forecast. Okay, if we have already, we are already in activity, so you will fill this part as actuals. Okay, but let's assume that we have just started activity, so we don't have actuals. So everything is a forecast. Okay, we fill it. Okay, here the customer in the beginning balance. Let's assume that we have already 100 clients, that they start using the demo version, and then they will convert it to an actual consumers. Okay, and then the new customers, and here the lost customers. We can put assumption on that. Okay, and here we have the consumer business ending balance. Okay, so we do it here monthly. Okay, and then we do it on an annual basis. Okay, but here it's monthly, and then it will be aggregated. We can fill at least only the first year on a monthly basis, and then make exception of growth rate, etc., for the next years, because generally we don't have this really detailed vision. Okay, so here is the renewal waterfall. I mean, for people who will renew for the second year or the third year for sure, though they will renew their subscription, those will make an end. Okay, and here we can take an assumption regarding the annual customer churn. I mean, here churn, it means the people who will leave, who are no more customer. Of course, you can find in red here some explanation or some guidelines that will help you filling this table. Okay. So here inputs in dollar. Okay, because here we're talking about number of clients. Here in dollar or in euro. Okay. So let's assume the price of the software or the application or the mobile application Okay, so here $10. So we have 100 clients. Okay, we have 1,000, etc. So here it's Excel sheet that it's related. Okay, and we need only to enter cases in yellow, and the rest is generated automatically. Okay, so here, for example, for the MRR rate file, and you need only to enter this case, and here it's explained. Okay, and here is, I mean, a part of the output. Okay, also if you have a service that you pay that is not for free, like maintenance, like backlog, or you backlog here, you add and you remove the burns. So you have the ending backlog and how many months of the backlog. Those work on assets will understand me. Billable heads, the burn per head, they are KPIs specific to the SaaS business. Here, if you have other revenues, for example, like if you sell spare parts, if you sell additional services which not mentioned in the basic package, etc., you can add them here. Okay, and for example, I know service booking. Okay. Here, the same if you have product C, product B. Okay, it's the same table. Okay, so at the end of the day, we have like a waterfall of the different revenue in dollar or euro terms for all the projection periods. Okay, now you move here to the operating expenses. Once we have projected the revenues, now we move to the operating expenses, and we can start with the personal here. So we can start by entering the department. The department name, or select it from a list, drop-down list. Yeah. Just activate the drop-down list, and we will choose whether it's R&D department, sales, services, support, marketing, G&A. Here we have the score list, and we have the possibility to change. Okay, so you can enter as many heads as you want. You are free here to add or to remove any kind of head. You enter the department name, okay, and or select it, okay, and here that should match the department name is listed at the link for summing purposes. You can here then enter the employee name. It's just for informational purpose only, and the employee title, okay, whether it's director, is developer, is analyst, etc. Okay. Then you enter whether it's a full-time or a part-time employee, because your the calculation changes. Okay. So if it's, for example, your part-time, then it will be. I mean, it's part-time will calculate rather hours, and the taxes changes. For sure, it depends on your jurisdictions in your country, but here is an assumption that you can change. Okay, and here it explains here for full-time normally 8 hours a day, 40 hours a week. Donc, this input, it drives the wage calculation, okay? So if part-time, it will take the hourly wage times the hours to calculate wages. Okay, I mean the hourly wage and minus times the number of hours worked. Okay, if it's full-time, you can enter the annual wage. Okay, and the column will be grayed out if you entered full-time. So if you entered the employee as part-time, enter here the average number of hours worked per month. Here it's great because it's full-time, but if we put it here, change it as part-time, for example, okay, then we can enter the number of hours here. Okay, we can then enter the local and national payroll taxes in this column, and then any other percentage to gross up the wages by this amount, and the benefits, if any, and also we can enter the employee start date, and if it's part-time or seasonal employee or an intern, we can here put an end time, okay, an end date. If not, we consider the end date at the end date of the projection itself. So if you are making projection on 5 years, we just put it here as the end, okay. So once we have all this done, okay, so here we will information will be gathered at the end, or summarized by department, okay, and by months and by year. Support, services, customer success, CEO, R&D, sales, marketing, general and administrative, non-operation expenses, etc., etc. Okay, so base it on the element you entered, okay, and the department, we steer the cost, the personnel by year and by department, okay. And here it's just to check that should be like a 0 here at the end each time, okay. So, for the other input, I mean the last input is all the other operating expenses, which is all the non-wage assumptions, okay. So it considers all operational department expenses, excluding wage expenses. Okay, so here these categories are optionals. Okay, but here we're using 3 categories at the bottom of the yellow shading. Okay, so cost of revenue, here travel expenses, operating expenses, which is categories. But all this is optional, okay. And of course, each time you can follow here the instruction. It will guide you step by step, okay, to fill in this different table. The idea is to have at the end of the day the same things. So the summary by expenses type, whether it's operating revenue, or costs of revenue. Cost of revenue, it means the direct cost, okay, or the COGS, okay. And here the operating expenses and non-operating expenses. And here we can have the same but by department, okay. The support, service, customer, it depends on the quality of the inputs we have, and we have at the end of the day all this calculation, okay. It's always the same. here we move by department. Okay, we go to the customer success department and we enter different type of costs. Okay, we can construct this table by going bottom up. Okay, I mean department by department, what are the costs, operational costs, and then at the end we have like a summary of all that. Okay, but if we don't have this kind of capillarity of details, we can just put gross data, and that gives the same sum up result at the end. Okay, so once we've done all this, all the others is just a consequence of the output of what we've done. Okay, so we will have here the revenue summary. It's all generated automatically. Okay, it's generated automatically. Here is based on what we have filled in the table of revenue. Then we have here the summary. That means the output, the revenues. Okay, here. Then the costs, and we have here the famous gross profit and the margin. Okay, and here the total sales expenses, etc. And here they are as a percentage, the ratio as a percentage of revenue. And here we have the total operating expense, and that will help us generating the EBIT and the EBITDA and the earning before tax, etc., etc. Okay, and here another details is the expense split. And in the same, here we have the cash flow table, the cash balance. I mean, the beginning of cash flow is draw the ending cash, and all the details related to the outputs to the financial statement. Okay, we can have here, I mean, also it's generated automatically the different chart flows and charts. Okay, it gives some visual to visualize a little bit our results. Here, some metrics, some KPIs which are generated automatically. It's customized to SaaS, but a lot of them could be used also for startup, for your startups. And if not, you can just check the list of KPIs in the website mentioned that I gave to you, and then to customize. It's just a question of you take the information from the correspondence sheet and just to make here the calculation. Okay, it's explain how, I mean, all these are the steps of the calculation of the different metrics. You can take your time to go through them. Here, for example, the cost of $1 of a total new annual recurring revenues. Okay, so for each new client, which is, or each one new dollar or euro of revenues, how it costs. Okay, and here we see that it's understandable because the first period generally is an investment period, so we invest, and then by time we depreciate and make the amortization of the costs. Okay, to reach maybe a steady rate once we have already spent or made all our investments. Okay, and here all the other metrics. Okay, you can take your time. Okay, so here, for example, the customer lifetime value. Okay, it means what a customer would bring to us as a return during the period, the average period with our clients. For example, let's take a client in average will make 1 year subscription, then he will renew his subscription only twice. Okay, so the lifetime of the customer within us is 3 years. So we'll see which is the value of this customer in our figures during this period. Okay, so here it's explained how it's calculated. Okay, step by step. Okay, so we can check in the website what is the formula, and you will see here it's just a calculation of the formula. Okay, and here to calculate first of all the long-term value, which is the gross margin, and then here divided by the churn, etc., etc. So here it could be interesting for you or not. So here the famous CAC, the customer acquisition cost. Okay, long-term value or lifetime value over CAC ratio, CAC payback period. Okay, so I mean how much period we use or we need to have our famous customer acquisition cost. Okay, here it calculates different other margins, the average cost of service. Okay, so here all our KPIs and metrics you can add where you want. You just take the formula and try to use the inputs, which are here the outputs of this sheet. Okay, here from the summary, to calculate any kind of input. And if you say that here you just put the different assumptions, then you fill up the revenue, you fill up the other operating expenses, the personnel inputs. Here I'd like to simplify. I haven't integrated any potential loan, okay, because we assume that on the first 5 years we don't generally, it's not common for a startup to acquire a loan from a bank. So for that reason, I haven't mentioned any kind of loan amortization, but for the depreciation of the investment, you can find it in the other operating expense. Okay, so I think I know that we cannot make really a deep dive on this model since we don't have enough time to do that, and also it's not practical. So you need to spend some time and to invest in your time to maybe to understand and to absorb all these elements. And don't hesitate. In the next session, we'll have maybe 5 to 10 minutes to have your questions and comments before moving to another topic. So thank you for your interest and follow back. And don't hesitate if you have any questions before we wrap up this second session. Okay.
Thank you, Badr. So as Badr said, we are still going to have a couple of sessions with him again. He's left very generously left quite a few of his contact details here. So please to take note. I think we already shared his LinkedIn profile with you, but the WhatsApp number and the email we have not, but I will also share this entire presentation with you. So thank you for staying over time. Before I let you go and before I hope all of you at the Justlers meet, can we do a group photo? Is that okay if we just turn on our cameras for a second and take a photo all together?
For sure.
Awesome. There, I think, Usama, this is the first time I actually see you. Hi, David. There we go.
Hi, how are you?
Good, good. Slowly but surely, we're coming in. Awesome. Only a few more to go. Hi, Hossein, Lillian,
Hello.
Juju, Kagai, Chris. Let's see. There we go. William, are you with us? Vincent, Veronique, there we go. Nice. Okay, let me take a screenshot. Yeah. Smile. Awesome. I have one, and then I will take one more. I think Aimer can't, apparently. He's having some connectivity issues. Yeah, okay. Sorry about that, but we will do this again, right? It's just, I thought it's a good idea because today there's quite a lot of us here together and we also have Iran with us. So one more, smile. Awesome, thank you. I will also share this with you on Slack. I will not hold you up any longer. I did post the link to the feedback form in the chat. I am staying on the call for 5 more minutes or so before I take a quick break before the justlers meet. I'll play some music. If you liked the track, I will also share the album link with you again elsewhere. And we would really, really, as always, appreciate your feedback. It is always very useful for us, but also for Badr. The link is in the chat. And yeah, I'll play some music. Feel free to stick around. And otherwise, I will also see you at the Justlers meet in 12 minutes. Thank you.
Thank you. Bye.
Thanks.